Assalamualaikum and hello everyone. We are from Group 8 and we were here to present our project from Management Accounting 2. We hope you find it informative.
So for the first point, I will be presenting about the definition of static budget and flexible budget.
Static budget is a fixed financial plan despite changes in sales volume. It is suitable for business with stable and predictable conditions. However, static budget is less accurate when real results differ from the original plan. Flexible budget is a financial plan that adjusts based on changes in revenue or cost. It is suitable for business where sales or costs often change. Compared to static budget, flexible budget is more accurate because it reflects actual business conditions.
Next is, I will explain to you how a flexible budget provides a more accurate financial performance evaluation. Firstly is realistic comparison. Flexible budget lets manager compare the actual result with what costs and revenue were expected to be at the actual level of the activity, and it also helps to avoid misleading comparison that the static budget can cause when the activity changes. Second is better decision making. For better decision making, a clearer picture of performance helps manager to make a smarter decision and about how to allocate resources, set prices and plan production. Thirdly is improved variance analysis. By using flexible budget instead of static budget, managers can identify whether variances are caused by changes in output levels or by how efficiently resources are used. This makes it easier to tell if the problems are due to the outside influences or the internal operations. And lastly is to prevent misleading performance judgment. By using a static budget during a fluctuating activities levels can create the false impression of overspending. In reality, static budget costs may be higher just because the unit were produced. By using flexible budget, it can adjust for this problem and provide a clearer evaluation.
For my part, I will explain about quantitative issue. The first issue is accurately forecasting activity level, where flexible budget rely on correct activity level forecast. Example like unit produced or so. If forecast is wrong, the budgeted cost and revenue will also be wrong. So the key point here is an inaccurate activity forecast equals to misleading budget and performance evaluations. The second is data accuracy and timeliness, where flexible budget needs to be updated and correct data equals like current price, cost and output. Using outdated or wrong data leads to wrong budget value. So the key point here is outdated data equals to wrong budget equals to poor business decision. The last is variable cost behavior analysis, where manager must understand how costs behave, which are fixed, variable or mixed. Incorrect cost classification affect how the budget adjusts with activity changes. The key point here is wrong cost behavior equals to inaccurate. Flexible budget equals to budget financial insight.
I will explain about the effect of quantitative issues on decision making. First, accurately forecasting activity levels. Flexible budget depends on activity level forecast. If these are wrong, the budget becomes unreliable. This can cause managers to misread cost or revenue variances and make poor choice, like cutting necessary spending or reducing output when it's not needed. In the end, performance evaluations and financial planning will become distorted. Second, data accuracy and timeliness. Using outdated or incorrect data leads to wrong budget figures. This might result in overhiring, overproduction, or excess inventory. Such decisions increase costs, cause waste, and reduce efficiency. It can also harm cash flow and long-term planning. Inaccurate data can disrupt cash flow and lead to flawed long-term planning by causing misaligned spending and investment decisions. Third, reliable cost behavior analysis. Misunderstanding cost behavior, like which costs are fixed or variable, means the budget won't adjust properly with activity changes. This results in over or underestimating costs, leading to poor pricing, bad resources use, and weak cost control. It also affects break-even and profit analysis, harming strategic decisions.
Now I will explain part 4 of the infographic, which is the comparison between the static budget and the flexible budget. Let's look at the table on the right side. We are comparing two budgets. One is a static budget, which is based on a planned production of 10,000 units, and the other is a flexible budget, adjusted to 9,000 units, which reflects the actual level of activity. First, both budgets have the same selling price per unit, which is 10 ringgit. So for revenue, static budget gives a total revenue of 100,000. Flexible budget gives 90,000. Next, let's look at variable cost per unit, which is 6 ringgit in both cases. For the static budget, the total variable cost is 60,000, while in the flexible budget, it's 54,000 ringgit. Fixed costs, however, remain constant at 20,000 ringgit in both budgets, since fixed costs don't change with the level of production.
So, when we calculate total cost, its static budget has 80,000 ringgit in total cost, while flexible budget has 74,000 ringgit.
Finally, the operating profit. Under the static budget, it shows 20,000 ringgit, but with the flexible budget, the profit drops to 16,000, which is more accurate based on the actual activity. So, this comparison shows how flexible budgets provide a more realistic picture of performance by adjusting to the actual level of output. It helps managers make better decisions and prevents inaccurate judgments that can happen relying only on a static budget.